Okay, we're going to go ahead and get started. Thank you for attending our home buying webinar presented by Provident Credit Union. Our session today should last for 1 hour with a Q&A session at the end. During the presentation, you'll have the ability to send questions to our webinar staff through the questions pane. Simply type in your question and click send. We'll address all Q&A at the end of today's session, and a copy of the slide deck will be emailed to all attendees in about a week. Our first presenter is Norm Whiteman. Norm, would you like to introduce yourself?
Yes, good afternoon. Thank you so much for spending the time with us. As you can see, I've had years of experience in the lending, being in lending, and both the residential and commercial lending. And then I've done literally thousands of loan transactions over the years, and very, very astute on all different types of loan programs. And I try to be very approachable, and it works good. And I look at a real estate transaction as a opportunity for a relationship, and that's how way I approach it. And the reason I'm at Provident is because and I've been here for 6 years. The reason I came to Provident was I was losing transactions to Provident, and I thought, why not? If you can't beat them, might as well join them. So anyway, that's why I'm here. It's a great place to be.
And our realtor today is Michael Mendenhall.
Hello, everyone. My name is Mike Minton-Hall. I've been a real estate professional for a little over 46 years, and I'm so happy that Provident has asked me to come in and talk about the real estate portion of today's workshop. And just to piggyback onto what Norm was talking about, he's an excellent, excellent mortgage consultant, and please reach out to him first thing after today's webinar. Thank
Thank
you.
you, Mike. A little bit about Provident Credit Union. As you can see, we're the 108th largest credit union in the United States, and top 10 in California. And we're celebrating our 75th anniversary as being in business. We were originally formed by the California Teachers Association in 1950. And from that, we've grown into a fairly substantial credit union and still have a relationship with the CTA. And as you can see, we're headquarters in the San Francisco Bay Area. Actually, we're in Redwood Shores. And by the way, we only lend in California. So unfortunately, if you have something in Arizona or other parts of the country, we can't lend on it. But we're a very good lender in California. So why choose Provident? There's a number of different reasons you can read there. I'm just going to add one other bullet point. We recently were picked by Newsweek magazine as being one of the top credit unions in America. So as you can see, we're very financially sound, and we really offer a lot of different services and products for you as a member. And certainly in the mortgage world, we're one of the premier lenders. So our goal today is to assist you in understanding the mortgage financing choices are, and also a little bit about what that means. We want to help you just define what your ownership objectives are and how to achieve them. And Mike will help us a lot with that information, demonstrate how you can buy a home for the best price with the most favorable terms. Again, that's Mike's specialty, and help you understand that what to expect when your offer is accepted. And again, Mike is the expert and will provide us with great information on that. Steps to successful ownership. There you see it's educate yourself about home buying. And it really is important. I mean, we're blessed that we have access to the internet, and we provide a lot of information there, but really, and it comes right down to it, you have to work with a professional on the real estate side. And Mike is one of those folks, and they're, you have to have that person to help you obtain a full pre-approval. That's something I do. What that means is that once you get approved with us, you can go out into the market and have be assured that you've been approved and you know what you've been approved for. And sellers like that, and real estate agents prefer that too. You want to summarize what your costs are. You work with a real estate professional real estate agent like Mike. Build your home search, And again, he's going to talk to us about that. Find a home and then make an offer. And again, he'll cover that in his section of this presentation. Okay. Home buying steps. Well, as you can see, when you're preparing to purchase a home, you want to make sure that you have funds for down payments, for closing costs, and things called reserves, 2 months of monthly mortgage payments, which includes principal, interest, taxes, and insurance. We'll get into that here just in a few minutes. Select a realtor. Expect 30 days to close the loan. Sometimes it can be done quicker than that. So we do have a program where we can do those in 10 days, but it's really up to the real estate agent to help you and guide you through the process. And then I help guide you through the loan process, and then get pre-approved. Again, we can't stress that enough because, as I said before, real estate agents don't really want to work with anybody that is not pre-approved because you're not serious. And then certainly sellers are not going to be interested in accepting an offer unless you are pre-approved. So that's it. Pre-approval process. So the 4 C's. When I got into this business a long time ago, I was trained, and there's 4 C's that are part of the what we look at in terms of the pre-approval process. We look at capacity. What that means, as it says, is the ability to make the mortgage payment and to make the payments on all your other obligations, debt obligations, and that means income. So how do you produce income monthly and annually? So we look at people that are salaried, that have bonuses, commissions, and RSUs. We take 100% of RSUs. Some lenders don't. We do 100%, same with the bonuses and our commissions. We also work with self-employed folks, whether you're Schedule C or LLC or corporation. We will we use tax returns the last couple of years, tax returns just to define that income, and we do approve loans for folks that are self-employed. And also we also look at other incomes such as rental income, alimony, and child support, distributions, and also distribution from retirement accounts. If you're retired, if you get a distribution, then we'll look at that income. The second C is capital. In other words, money you have available for down payment, and also money for closing costs and reserves. And that takes the form of checking accounts, savings accounts, CDs, money market, mutual funds, retirement funds, anything that's liquid, stock accounts, overseas accounts, and gift funds. And we also will look at Bitcoin or crypto. So as long as you have statements that show the crypto, we also will accept that as sources of assets that you have. Third C is collateral. Collateral means the value of the property. When you get in a contract, you have a contract price. Let's say it's $1 million. It's confirmed by doing an appraisal, an actual appraisal. Somebody goes out and looks at the property, looks at the market conditions and the sales that have occurred over the last 90 days. And that usually will substantiate the purchase price or the contract price. I would say in the last 3 or 4 years, I have not seen a transaction where the appraisal has come in below the contract price. Usually comes in at contract or a little bit above. And also, collateral is also, let's see, whether there's owner occupied or investment that you're buying, also the type of property, whether it's a single family residence, it's a condo, a townhome, or a 2 to 4 unit. So all those are property types that we lend on. But as I said, the appraisal, the collateral of the loan is important, and we justify that with the appraisal. The fourth item is the credit. So we look at all 3 credit bureaus, Experian, Equifax, and TransUnion. We take the scores. We do hard pulls on that because we run everything through an automated underwriting system. So that's required to get a decision on that. But what we do is we look at, say there's one borrower. We look at the 3 credit scores. We take the middle score as a representative score. If there are 2 borrowers, we take scores from all 3, all 3 for both the first and the second borrower. We look at the middle scores of those, and we take the lower of the 2 middle scores. So that's what we look at. So I say there's 4 things: the capacity, the capital you have, the collateral, which is the value of the property, and also credit, your credit scores. Okay, next. Pre-approval elements. So these are the things that we look at. We when we determine whether you're qualified to buy this property. Also, these are elements that the underwriter is going to look at through the process. Loan to value is a term that means what's the value of the loan as it compares to the contract or purchase price. And by the way, if the appraisal comes in lower than the contract price, we use a lower the contract price for or the appraisal. The loan to value, they'll hear that term. Another term is debt to income ratio. That's looking at what your total debt is if you include the housing payment, including principal, interest, tax, insurance, plus any other monthly obligations you have, such as car payments, credit cards, student loans, and items like that. We take that total. We look at what your income, the basis of your income. Is it salary? Is it bonuses? Is it RSUs? Are you self-employed? Is it whatever that gross amount monthly? We take the gross amount from the total debts, divide it by the total gross income, and that's called the debt to income ratio. So the acceptable debt to income ratio ranges anywhere from 40 to 45%, depending upon the type of loan that you have. Okay. We also look at property type, if it's a single family residence, condo, townhome, if it's a 1 to 4 unit, owner occupied or non occupied. The differences on condos, we have things called homeowners association dues, or HOAs, which is part of the monthly mortgage payment. So there'll be principal and interest, taxes, insurance, and then HOA. So that would represent what the total gross mortgage payment is, or excuse me, the housing payment is for the month. And then reserves. What reserves are is monies put away, which are based on 1 month of reserve is equal to 1 month of principal, interest, taxes, insurance, and HOA if applicable. And then based on the loan program and that sort of thing, we could collect anywhere from 2 to 6 to 9 months of reserves based on the loan program, the loan to value, and different attributes of that loan. And so the reason for the reserves is not to set you up for failure once you acquire the property, because as you know, it's very expensive, and you want to make sure that you have the ability to make the payment in case something's happened. Case in point is what happened with the 2020 pandemic, where people were furloughed or laid off. And so, it's good to have those reserves to keep your mortgage payments current. We were quite lucky at Provident in that we didn't have any losses due to any of those circumstances, and that was because of our reserve requirements. Next. What not to do. This is really, really important. Don't go out and buy a car or take on any big loans. Don't co-sign any loans. Don't miss any credit card payments or car loans, whatever. A little bit about credit. If you have a 30-day late in the last 12 months, that is could hit your score between 70, 80, even 90 points. So you want to make sure you keep current on all your debt obligations. Changing jobs, not so much a big deal. If you're in the same line of work, people change jobs all the time. We would just need to see if you did change a job, we would need to see the offer letter from the new job. And also we would need to see at least one pay statement from the new job showing what you indeed are getting compensated for. And then moving money around, what that means is during the process, we will analyze and look at what kind of asset amounts you have. You have checking, savings, CDs, whatever type of assets you have. We want to make sure that we understand what that is. We have statements for that, and that the money, and we have a form that we use, cash to close, where we look at what accounts you have listed, where the down payment and closing costs are going to come from. And so we want to make sure that that money is in those accounts. We've run into situations where people have closed on a loan and have transferred money in the escrow, and there are accounts that we knew nothing about. So that delays that. So we have to make sure we understand what accounts you have and try not to move the money around. If you do, we're going to need to source that move and document that move. But anyway, those are the things really to keep concerned about during the process. Next. Types of loans. This is a little bit of what type of loans we have at Provident. We do conventional products are also known as agency products, Freddie Mac, Fannie Mae. We can do 10, 15, 20, 30-year terms. The loan limits you see down here what are in the Bay Area. Conforming, you'll hear conforming. That is the loans up to 806, 500. Anything over that, super conforming, 806 and change up to $1.2 million. That's a super conforming. Anything over the $1.2 million is jumbo. Also, the 2 and 4 unit loan limits are higher. Again, the difference between conforming and super conforming is the agency have things called loan level price adjustments. That's how they compensate themselves for risk. As you jump from a conforming to a super conforming, the interest rates are going to be higher because the risk is greater based on the loan amount. So, and we provide loans in all three of those four of those categories. We also, which most of our loans are originated on our portfolio programs. We have a 3-3, which means the initial rate is fixed for 3 years, then it could adjust every 3 years thereafter, or the 5-5, which is the same scenario where the first 5 years at a fixed rate and could adjust every 5 years after that. And those are based on a 30-year term. We're very aggressive in terms of pricing and interest rates on those programs. I'd say about 95% of our loans are originated mostly on the 5-5, but also we just introduced the 3-3 not too long ago, and we're getting a lot of traction from that. We also provide fixed rate seconds and home equity lines of credit. Some people, when they purchase a property, they put 80% down payment and have a 10% second mortgage. We don't entertain that. We basically say we can do a 90% loan to value, and it'll be a lot cheaper to do it that way than it would be to take on a second mortgage because the rates on second mortgages are pretty high. Anyway, that's the type of loans we have. Just some of the highlights, some of the unique programs we have. We talked a little bit about the 3-3 and the 5-5. It's also known as a movable. That means you could move that mortgage within California. If you get $1 million loan and you're in the Bay Area and you decide you want to move to the Central Coast, you move. You still have $1 million balance, and let's say if your rate is at 4%. Which is not where we are today, but say a few years ago, you could move that mortgage to the new purchase, and then if there's any difference in the loan amount, then we blend that rate, and so typically you end up with a much lower rate than the market. So that's a great feature. The other thing about a couple other features about the 5-5-3-3 is we can modify the loan because you own it. That means you can modify the interest rate, the remaining term, and the adjustment period. And what that means is, let's say you get a loan for 5.5% today on a 5-5, rates drop first quarter or second quarter of next year. Say they drop to 5%. You can modify, instead of refinancing, you can modify your loan, and it's a lot cheaper to do the modification. You can, like I said, modify it down to a lower rate, reset the 30-year term, and reset the adjustment period to 5 years if that's what you're using. So that's a great feature. A lot of people like that, especially in a downward trending interest rate environment, which looks like what we're going to have over the next couple of years. The other big feature that people like is a float down option. What that means is, let's say you get in a contract, we lock in the interest rate. And again, these are only on the portfolio products. You lock in the interest rate. If between the time we lock in the rate to the time of close of escrow, if our rates drop, then we'll float down that rate. In fact, I'm doing it today because our rates went down a little bit yesterday. I'm floating down some of the loans in the portfolio. So we're floating down to a lower interest rate. So I don't know of any other lenders that will do that. So that's a great feature to have, kind of protect you and keep you, with the current interest rates. We also have another program called a Home Purchase Advantage, or HPA. Again, this is part of the 5-5 and 3-3. It basically gives you an opportunity to put low down payments, mortgage products. You can see we can do a loan of $1 million with 5% down, up to $2.5 million with 15% down. You will have mortgage insurance, but mortgage insurance is not a dirty word anymore. It actually helps you to leverage. That's what this program does. And we work with 3 different mortgage insurance companies. We have preferred rates with them, so we're able to offer a pretty good alternative to doing 20% down. Also, we have another program with all of our programs, which is called the Planned Development Loan. And that's really new construction. And actually, I have a few of those uh, loans in my pipeline. What it does, we reduce our lender fees, which are usually pretty low, about $1,200. We reduce the lender fees by about $1,000. So our lender fees are $200, and that competes with the builders with their exceptions to or closing costs concessions, based on using their lender. But what happens, their lender usually is a lot higher in rate than what ours is. So that's another great program. Next. Rate lock. So I'll just let you read that. But basically, you want to lock in your interest rate because that gets you where the market rate is. So that protects that rate for a period of time, usually 30 days if it's a conforming loan, or sometimes 45 days. On the portfolio products, if it's a purchase transaction, we lock it for 30 days. If it's a refinance, we lock it for 40 days. And again, it protects you against any rate increases during that period of time that you're locking in and working on your transaction. As we mentioned before, with our portfolio program, we can do a float down on the lock during the lock period. So it's a nice feature to have. Next, monthly payment. As we said before, these are the elements of the mortgage payments. A principal every month, a portion of your payment goes at principal, portion of it goes at interest. Taxes, 1/12 of real estate taxes, 1/12 of homeowners insurance, if that's what you choose to get below. But that's what's going to be part of it when we calculate whether you qualify. Also, mortgage insurance when that's applicable, and also we include the homeowners association dues. So those are the elements that go into calculating what your monthly mortgage payment will be. A little note about impound escrow accounts. Not necessarily if you put down less than 10%, then you're going to be required to have, actually, if you put down less than 20%, then you can have impound accounts. But with us, if you put down 11% to 19%, then you're not required to have an impound account for real estate taxes or homeowners association, or homeowners insurance. But you still have to have a impound for mortgage insurance. So, and again, as it says here, homeowners dues are not impoundable. You can't impound those. You have to pay those separately. Okay. And then, by the way, just about property taxes, first installment is due November 1st, so that's coming up in a few weeks. It's delinquent December 10th. Second installment is due February 1st, delinquent April 10th. And then homeowners association renewals are based on the anniversary date of when you got the loan and moved into your house. Okay, that's it. Okay, Mike, here you go.
I'm on board. Thank you so
Thank
much.
you.
And quick reminder to everyone listening that as a real estate professional, we are unable to assist you unless you've met with a lender, because once you leave that meeting, you should have a real good understanding with Norm's guidance of what you can qualify for, what you're comfortable getting, and then make a decision, and then you can talk to an agent. All right, so here we have an estimated buyer's closing costs. Now, to start out, in the state of California, we have what's called customary closing costs per county and city. That means from one county to another, what might have been a buyer fee in one county could be in the next county a seller's fee. So this is if you will, fictitious county and city. We're just kind of giving you an idea of what they look like and possibly price range. But if anybody would like to know who pays what in the county or counties that you are looking in, you could contact either one of us and get that information. Okay. Here we have a sales price of 1 million, a mortgage of 800,000. They're putting 20% down. Loan application fee, 0. Thank you, Norm. Lender fee, $9.95, flat rate. Very, very good. Loan origination fee, points. Well, points. Points are a percentage of the mortgage amount. Let's say you're paying 1 point. That would be 1% of the 800,000. Now, it's not always a point. It could be less, it could be more. The most common thing that people pay points for is probably to buy their rates down. Sometimes it's a good time to buy your rates down based on your situation, and other times it might be a bad thing. That again would be something Norm could help you with. Tax service fee, $119. Make sure your tax paid on time. Credit report, $55 per person. Appraisal fee. Norm talked a little bit about the appraisal. I put in $700. It could be less, it could be more. There's many different factors that figure into that. But appraisal is something that is really, really key. And we'll talk more about a market analysis and how we determine values that the house appraises. As Norm has said, we have very, very few issues with homes appraising really over the last number of years. It's been that good. Hazard fire insurance. Just anybody living in the state of California knows we have a little bit of issue with insurance, and it's not just the fire portion, but that's one big portion of it. If you're going to be buying anywhere that has large trees, green belts with trees, anything like that, in the mountains especially, you really want to call your hazard insurance carrier, whoever your insurance person is, prior to making the offer to find out what will the coverage cost. I put $1,000 in here. That's assuming it's a smaller home. That's per year. It's a smaller home, and you are not surrounded by trees. So you got to keep all that in mind. PMI, private mortgage insurance, as Norm had mentioned, if you have less than 20% down, you're going to have MI. And you know what? MI is not a bad thing. It's so inexpensive anymore. And as Norm can explain all the ins and outs on that and how it can drop off in the future. Impound accounts, okay? Optional. I like impound accounts. This is where you're asking Provident to make all the monthly adjustments and payments for you. So you would send one amount in every month to them. Then when times come due for taxes, insurance, etc., they will make those payments for you. It's seamless. It's what I've done for as long as I can remember once it became an option. So really a nice way to do your payments and not worry about those late fees if anything was not in on time based on you missing the dates. Two one-time insurance policies. First one is the CLTA, or what we call the buyer policy. And the next one, the ALTA title insurance, is called the lender's policy. Why do we have insurance policies for the buyer and the lender? Because both of you have interest in the property. And what we're insuring is the title to the property. So after you move in, if something comes along and clouds your title, means makes you not able to sell the property, refinance the property, you're frozen. The insurance will kick in and they'll work on getting that taken care of for you. Escrow fee, that's the company that's handling all the paperwork in this transaction for the perfected close. And it's $1,200 with this particular escrow company for $1 million sale. So as we go up in price, the cost of the closing paperwork goes up, but it's not huge. Like if you went another $100,000, it would be fairly negligible. Recording notary fees. Let's make sure that everybody's who they say they are. So it's $300 for a notary to make sure that everybody has the proper identification and can sign. Up on the top right, these are the most common inspections that we'll see. First one is termite inspection, looking dry rot, wet rot, pest infestation, and plumbing leaks. Second one is the roof inspection. You don't get those on HOAs 99% of the time because the roof is covered by the HOA. However, on single family homes, you're always going to want to get one. And that's $250 and up. Okay. Right now, on some of the little bit larger homes, it's anywhere from $750 to $1,000. And they're looking for the condition of the roof, any repairs that may be needed at this time to make it watertight, and what's the remaining life expectancy of that roof. Property inspection is an all-encompassing inspection where the property inspector, he or she goes out to the property, inspects everything going through the property. That means if there's a door, they open and close it. If there's an outlet, they test it. They're looking at everything for an overall condition of the property. They're looking for hazardous situations, and they're also going to point out things that when this house was built, code was such and such, but now it has changed. It's not a requirement to change it, but you may want to simply from a safety standpoint. Once you have all three of these inspections, I can tell you what to expect as far as replacement, improvement, what are those costs going to be over the next 5, 10, 15 years. Miscellaneous charges, again, differ in each county, but in this fictitious county, we have a city transfer tax of $1,650 based on the sales price. We have a county transfer tax of $1,100 based on the sales price, and prepaid interest. This is just an example showing you that once you sign, let's say it's in the middle of the month, you're going to have 15 days of interest payment to bring in until we close this transaction. Grand total $12,701. Now, it could be closer to $20,000 in some locations. It could be less than this. Again, It changes county to county. Okay? All right, so every time I sit down with the home buyer, after we talk about what purchase price your comfort range is in after your meeting with the lender, we're going to talk about what type of home you're looking for. We're going to try and put as much information into this search as possible. This is just a sample of the number of questions that I ask. Um, we talk about everything you want to find in the home. And if we were to find that home, how long do you think you would live there? Number of years you would occupy a home. Let's say you say if it was everything we wanted, it was the right townhome, if we're looking for a townhome, we'd live there 5 years, maybe 6. All right, great. Then we're going to go from left to right and ask all these questions. And I'll just use a couple as an example. First one, bedrooms. How many bedrooms do you require for the 5 years that you're going to live there? What would you desire? What's neutral, or you don't really care if you got that many. And negative is like, oh, I don't want less than this and I don't want more than that. So again, you can have negative search, required, and everything in between. Then we talk about baths, family rooms, separate dining rooms, garage, carports, appliances, and systems, a huge one because we talk about the kitchen. And that, for a lot of people nowadays, they really like to cook. It's becoming more and more popular all the time. And you're finding that you're very picky about what you want in your kitchen, rightfully so. A lot of you, if you're looking at homes that are 35, 40, 50 plus years old, and if they haven't been completely updated, that's something you may want to do. So we would talk about what you expect in your perfect kitchen. And if you found a house that was right in every other way, but you had to update the kitchen, I would know what you want. I could tell you around what it's going to cost to do those upgrades. We talk about, how the heating and air conditioning, or as we call conditioning, is taken care of. Is there AC? Is it electric heat pump? Is it forced gas, electric baseboard? There's different options, and some people do have allergies and preferences. Again, if you find a property in the mountains and even some in the city, there's still a lot that might be on sewer septic. We'll talk about what that's going to cost to make you hook up to the city because all the cities are slowly getting on board, requiring you to connect. Washer dryer is a big one for people who are going into condos and townhomes because if you're in the older condos and townhomes, they don't always have them. Quite often, they have laundry rooms and they're coin up. You need to go in there and pay to have your laundry done. You might be competing for laundry time with your neighbors. So a lot of people want a washer dryer. If you find an old community that doesn't have them, we'll investigate to find out if you can install one, where it could be installed, and what that would cost. Okay? All right, let's say we're talking about a single family home here. So we're getting that roof inspection. You're going to live there 5 years. So what would you require of that roof? Well, I would say, and it's not always holding to this like a line in the sand, 10 or more years. And that way, if you're going to live there 5 or 6 years, you're not going to have to replace the roof when you move. If you live there 10 years, you're going to be putting a roof on that place. And the question would be, if the roof costs you 25,000, you put it on, are you going to get 25,000 more for that house? Tough to say. So we like to get a house with some roof that has remaining life in it. And then we talk about aesthetics, type of siding, stone, stucco, wood, whatever you like, fenced yard, how big is the front, how big is the back, do you like to entertain, will there be play structures for the kids, do you need a patio to barbecue, all the above. We'll have all those discussions because they all cost to improve and they all cost to bring in new if you don't have it. Pools. Now, I put pool in here because this is a really good one to explain. You need to walk in the opposite direction of where most buyers are going. If I have 100 people in a presentation and I ask show of hands of how many people want pools, I'll get like maybe 2 or 3 at most out of 100. Most people say I don't want a pool. Well, I understand that, and we'll talk about that. And I also understand if there's anybody out there listening that would like a pool, you can get houses with pools and not pay the price of what those people paid to put that pool in. And why? Because the majority of buyers don't want pools, so those houses don't even get looked at. I sell them every year with pools in the backyard. My buyers don't want them, but when they see the price they get the home for and what it costs to remove the pool, they got a good deal. So all I'm saying here is things like pools in the backyard or just concrete for the backyard and or the front yard. It looks horrible. Well, maybe you get a really good deal on that house because most people don't want to deal with it and it's not as expensive as you think to rectify it. Then we'll talk about neighborhood, architectural styles that you like, price range again, HOAs. Anytime there's a property, single family townhome or condo, and it's in an HOA, your real estate agent should go through that documentation very closely. And most important thing that they look at are the financials. Are they operating successfully or are they underwater as far as having enough money to keep it running annually without asking for special extra assessments from the owners? So we look very, very careful at that. Commuting times. We always like to talk about where do you go during the week and the weekend? Where do you work? Where do the kids go to school or you want them to go to school? Do you have a favorite shopping spot? How about relatives you're going to visit? Let's look on a map and see how long it takes to get to all those locations. Is this a good commute location or a poor one? Okay. All right, two types of homes that most people are going to be looking at if you're listening now, and that would be a single family home, detached, shares no common walls. There's an exception to that now. We have what's called duets. We've had them now for about 25 years. There seems to be more and more of them. They're like duplexes. Duplexes, one person owns the entire both sides and maybe lives in one side, maybe doesn't live in either side and rents both sides out. A duplex is a whole purchase. Duets or attached single family homes look the same, but there's different owners for each side. So that those are out there, but they're called single family home, and you have to look very careful on the listing where it says attached. Generally includes front and rear yards. Some of the new ones, in fact, quite a bit of the new ones, don't have anything but a very small side yard, enough for garbage cans and some bicycles. And those communities, the cities are insisting that they put in parks right in the middle of the community, places for kids to play, but the backyard is not always there. Owner responsible for maintenance of property inside and outside. No one's helping you take care of this. The exception being some single family home communities are in an HOA where there's a gardener that will come and take care of the very front part of the garden of the house. But in most cases, you're responsible for everything. Owner pays all insurance costs. The reason I put that in here is because on our next one, townhome and condos, you're paying a HOA monthly fee, and in that, part of it is master insurance. So you're paying on the single family home that insurance. Over in the townhome and condo, you're paying a monthly HOA, which includes the master program. Okay, so let's go over there. Common interest developments. They share common walls. Monthly homeowner association fee. The HOA fee covers exterior grounds and building maintenance. Now, there's always exceptions. Every community is a little different. So you have to read through it closely to find out what is covered and what is not, and what is your responsibility. The HOA generally pays, again, here it is, master insurance coverage. Now, there will be a smaller, what we call walls in insurance for a lot of these properties. And that's kind of like renter's insurance. It's not too pricey, but you might be required to have that. And again, we're going to review the financial health of the HOA in detail. Both are good purchases. They're just both a little different. Okay. All right, where does inventory come from that goes on the multiple listing services? Well, here it is. First one, top left, are foreclosures. That are properties that have been taken back by lenders and then they're remarketed through a company like mine. There's a myth out there that foreclosures are great deals. They're just a house for sale. Paperwork's a little different. The way you operate on them is a little different. But it could be the best deal of the day. It could be the worst deal of the day. It doesn't matter to me whether it's a foreclosure or any of these other ones. It's the property itself. I don't care where it comes from. To the right, we have probates, anything to do with the legal system in the state of California where the courts are somehow involved. It can be very minor involvement to very, very heavy involvement. And both foreclosures and, more importantly, probates, I would really get an experienced real estate agent because you can get burned on those pretty fast if your agent doesn't know what they're doing. Bottom left, corporate transfer. I love corporate transfers. They generally happen September through December and the companies are transferring, let's say, employees that are moving up, doing really well, and they say, "Oh, we want you to run the Boston office," and it's a great promotion, and they already own a house here, didn't thinking they were going to get transferred, but it's too good to pass up. And the company will use a company like ours. You know, I work for Keller Williams and they have a relocation arm, and there's so many of them out there. The only thing about the corporate transfers I really like is that a lot of times, since the people that are getting transferred, it's a promotion, means they've been doing really well. And what do they do with their money? Well, if they bought a 70-year-old home in the Bay Area, they probably put in new kitchens, they put in dual pane windows, they put in a lot of stuff. So this time of year, although the number of listings may go down a bit, you're going to find that September through December, these can come up. And I would go look at them, and your agent can actually run a search for relocation company, or just look at the listings when they pull the homes that you like, and they can tell you it'll be on there. Then in the bottom right, conventional listing. That's everything else. Everything else that is on the market is because someone needs a bigger house, a smaller house, but it's called conventional listing. Okay? All right, so you built that search. That email home tour is going to come to you 7 days a week, 24 hours a day. Up on the top right, you're going to see it's going to have the number of bedrooms, the number of bathrooms, approximate building square footage, approximate lot size, and year built. And I'm going to stop right there. I look at that stuff and go, okay, it's enough information for me to show this property. But if you have interest in this home and say, hey, I really think I want to look at the disclosures for this property and get a market analysis, which we'll talk about here next. But I'll say, okay, first I'm going to verify all this information if it's accurate. The fact that it is a 3-1 and it has 1,200 square feet, that's a lot of square footage for a 3-1. So I'm going to want to look at permits and find out if things were done with permit. Well, I already know because I put this listing in here. If you go down and read the comments at the bottom, it says the family room addition, that's how it got bigger, was permitted. But then it says it's been turned into a third bedroom. It was originally a two-bedroom without permit. That means the appraiser will not look at this as a three-bedroom house. They're going to say it's a two-bedroom, one-bath house, not a three, but they will use the square footage of the permitted family room. You really, really have to verify all this information. And there's little things down here in the public comments because these public comments will be on flyers. They're going to be on the internet, and you can give or take, kind of get a read on the property, what kind of condition it is based on some of these comments. And I'll give you some of the more popular ones on the next slide. Okay. All right. So on the left, if you see in the listing comments, be cautious of the following. All the property needs is a little TLC. Agents love to say that, but it's rare that I ever see a house just needs a little tender loving care. TLC generally means, ooh, possibly take it down to the, foundation and rebuild it. It could be that bad. It could just be major, major costs in remodeling. And for first-time home buyers, that generally is just a killer. So be cautious of TLC. The next one is great for first-time home buyer or investor. That's appealing to two different people. And what that is generally a property that, let's say, is 50, 60, 70 years old, mostly original, but updated as needed. In other words, a house that own will probably have a newer roof on it because it's going to have two roofs in that time frame. Probably upgraded the piping to copper, maybe did some electrical work, might have updated a bath at some point. So those can be great for a first-time home buyer who says, hey, I can take this on, live here, and while I live here, I'm going to improve it because I have the tools and the wherewithal to do it, or maybe someone in your family does, or maybe you're just going to pay as you go. What's the goal? When you sell 10, 15 years down the line, it's going to be worth a lot more money with those updates. Investor does the same thing, except they buy it, they rent it immediately, maybe hold on for 10 years, then they remodel the entire house and put it on the market. So kind of the same game plan. Following the two at the bottom, contractor special and fixer upper, those are generally all cash transactions. When they're coming out and telling you this is for a contractor, this is a fixer upper, it's probably not going to pass health and safety certification, and therefore you're not going to get a loan on it. Okay. Unless you're a contractor or someone who flips houses for a living, have all cash, it's going to be tough for you, John Q. Public, to get a loan on those properties. On the top right, if you're looking for something just to move into, these are the magic words: recently remodeled, new, renovated, move-in condition. If you see one of those four, generally the home's going to be in a fantastic shape. And I put those at the top of the list if that's what you're looking for. Okay. All right, so now you know where you want to buy because you've been looking for a while and you've X'd out the places you've decided you didn't want and you're highlighting and specializing in the areas that you really want. Now you're going to shift it in second gear. You're going to look at homes 24 hours a day, 7 days a week. Bit of an exaggeration, but not really. What I'm saying is you're going to be looking at very few houses because you really know what you want now. But when they come up, view the listings ASAP. Even those that says offer due date will be determined after this week's open houses. I still see those disappear in a day. Okay. So you really have to be on top of getting out to see these homes. More and more people since COVID are starting to stay in their homes when they're on the market. So if they're there, make an appointment when the seller is there so you can introduce yourself. Nothing helps get that house more than the owners having met you, got your names. They'll recognize it when that comes in on a contract. And sellers tend to like to work with people they've met, just human nature. So when you're in the property, look in, under, and over when viewing a home. That means, yes, you're not an inspector, but open and close, turn on and off. You really want to take your time looking at this home if it's one you like. If you walk into it and you don't like it within 5 minutes, then you just leave. Okay, shoes. I put this in here because I was doing this before COVID, but now since COVID, I'd say 98% of the homes are requiring you to remove your shoes before entering the home. You'll find those booty baskets at the front door. After the first weekend of open houses, those things are disgusting. I always tell people, buy a bunch of Costco socks and just put holes in them, walking in your socks around the property. You can slip in and out of your shoes quick, and it's better than putting those booties on your feet. Do not bring a crowd when viewing. Okay, who goes to the initial viewing? You, the buyers, people that are going to live in the property, or if there's a family member that gifted you money, they are considered to be part of the buying team. So that's who goes. Who do you bring later? Family, friends, and coworkers that were not involved. You bring them on a separate showing because they're very, very distracting. And whenever they come in, just the comments drive my buyers crazy because they're confused because some people like it, some people don't, and they give strange advice. Save that for after you've determined whether or not you're going to buy this home. Okay. Okay. Please do not make negative comments about the home you are viewing. Okay. What I mean by that? Well, a lot of these homes, if not most of them, will have cameras in them and they activate as soon as they see someone walking. And that person's at a computer somewhere, gets a ping, and starts watching and listening to you. They like to hear what you say about the home. Tell all my clients, you know what, write down your big questions like, hey, Mike, what's it going to cost to remodel this kitchen? You don't want to ask that on camera because maybe they remodeled that kitchen 5 years ago and it's their pride and joy, but you want it to be different. You probably love the home. You just want to remodel the kitchen differently. Well, all they hear is they don't like my kitchen, which we spent a lot of money and time on. So I always say, you know what? Really involved questions about the property. Let's do it out front away from the property. Okay. Again, don't bring a crowd when viewing the home if it's going to be a detailed investigation of the home. Don't use the bathroom in any home you're viewing. We're not supposed to use those bathrooms, and people make the mistake of, oh, it's a vacant home. I'll just slip in here and use the restroom. And a lot of times in vacant homes, water is shut off. Always ask your realtor, and usually going to tell you, let's hit a Starbucks or something next because we really, really shouldn't be using the bathrooms. Okay. All right. If somebody tells me they really like the property, I will do a second walk with them. And this is just a portion of what I do. But basically I say, okay, great. You've been through it once. Now let's walk through it even slower because you say you really like it. The first time was just an overall, sense. How did you feel about it? Oh, I really liked it. It felt great. Okay. Now let's walk through and we do the opening, the closing, the turning on, the turning off, how many people can stand in the kitchen at one time, all the above just to make sure. Huge commitment to make an offer and buy a house. And I'd hate to have anyone say I bought the wrong house. Luckily for me, that's not happened yet. So, and I don't intend it to. I really want you to take your time and I'll walk you through all these questions. Okay. All right, comparative market analysis. So for you to determine value, I tell my clients always the same thing when they say, is the house worth what they're asking for it? My question is, let me do a market analysis on the neighborhood, focusing on sold properties that have sold in the last 90, and I even go sometimes to 150 days if there's no listings that are that recent. Use data from the same geographic area. That means same schools, bedrooms, baths, square footage, as close as you can get them to each other. And what you're doing is As you can see on this page right here, we've got the active listings. There's only one, so that must be the one you like. Then down under that, there's three houses that sold that are very similar in square footage, probably the same builders. Lot sizes are a little different. Now, behind this market analysis, after the first page here, you're going to see individual pictures of all the sold homes. You can see the inside, the outside. You get to look at whether it's on a busy street, a quiet street. How big is that lot? What is the lot laid out like? So you actually get a visual of what I've printed on the first page. And you can say, wow, that was the high sale that sold for X, and this was the low sale that sold for Y, and everything in between. That's called the window of value. And all you're trying to do is match the home to the property you're looking at condition wise. Like, was it the same kind of street? Was it quiet? Was it busy? Has everything been updated or partially updated? And you have a discussion with your agent about all those options. And it really is super helpful in helping to determine what you think you should offer on this home. And more importantly, will it appraise at that price? And if we have houses that sold at that price that are similar, appraisal should be no issue at all. Okay? All right, California Purchase Agreement. Best time to see the California Purchase Agreement is when you do not have a home to make an offer on. In other words, you haven't even started looking at. So I tell my buyers, you know what? I'll be happy to send you a sample purchase agreement. There's two that we use here in the Bay Area, CAR and the PRDS. Both are good. I would probably send the CAR out for people in, say, the southern part of the Bay Area, and probably PRDS for people in the northern Bay. Just kind of what agents typically use, but you can use either one. When you're making an offer, you want to make sure, ask your agent, is this the most current revision date? And almost always it is now, because the nice thing now is most agents use everything online, all the databases. We use the same ones to get our purchase agreement and information from, but there's still some out there, a good number of them that do it by hand. So you want to make sure they're using a current and updated purchase agreement. You're going to talk to your agent about each home. Do we need an inspection contingency? In other words, do we like the inspections? Did they share the true condition of the property? Are they even missing an inspection? And I would be the first one to tell you, if I don't like this inspector's way that he or she did this, I recommend we get a different one. You might want a financing contingency, but with Norm's help, you won't need it because he's going to have you fully pre-approved. So you're good to go. Lastly would be the appraisal contingency, which I just talked about. And the appraisal contingency, although you have the ability to put one in, I would say 95% of the homes I've sold in the last 10 years have zero contingencies. Now, the ones that we did have contingencies on, there was good reason, very good reason. And the reason contingencies are not attractive is the seller wants to know, once you've got your offer accepted and a major 3% earnest money deposit, that you're not going to back out. And after you look at properties for a while, you'll become more and more comfortable with that idea. Is it required? No. You have the option to have a contingency at all times, and I would never want to put an offer forward that the buyer's not comfortable with. Okay, so you'll have a discussion on all of those and possibly other contingencies as well. Okay. All right, so offer process. You and your realtor will decide what to offer looking at the market analysis. Now, I, as an agent, feel it's my job to educate you and guide you. I'll never tell you what to offer. I'll say, are you comfortable in this price range? And let you decide, because I don't want you being shoehorned into something that doesn't feel right. Discuss possible contingencies, which we just mentioned. Your realtor will present the offer. You do not go to the presentation. Seller will respond by accepting, rejecting, or making a counter proposal to your offer. They can counter the offer. You can accept, reject, or counter the seller's response. So you will have all this to go through on any house you're considering to make an offer on. Okay? Okay, right, real estate agent. Well, you know what? It'd be great if you had an agent with tons of experience, but it could be a relative, it could be a friend of yours, got in the business in the last, say, a year, and you're feeling a little uncomfortable because you don't know about their experience. Just ask them, are they working under the experienced wing of a training broker or broker in the office? If the answer is yes, good to go. Okay, you've got someone looking over their shoulder. If it's someone who's been around for a number of years, just ask them, how many homes did you sell last year? They can tell you, they can show you a list. You can print it out off the multiple listing service. How many were representing buyers? How many were representing sellers? And if you're a first-time home buyer, always tell your agent you're a first-time home buyer because you require a lot more time on their part. A good experienced agent will tell you if they don't have the time, and they will tell you if they do have the time. They would love to work with you. It's just they look at you and go, okay, that's like working with three different buyers because they're going to require a lot of handholding and education, which they should provide to you because you need it. Okay, during your meeting with that agent, establish goals, determine a strategy, when you're going to meet, what times you're going to go out, develop timelines to review the search and anything else every couple weeks so you can update with things that you've learned and now you want to change some of your search guidelines. Okay? As Norm said, the average close of escrow is around 30 days. It can be faster, it can be longer, but this gives you an idea what goes on in that quote 30-day time period. These are all the people below you. Who are you? You are the CEO. And like any good CEO of a company, you have no clue what's going on. All the people that do are down below you. And that's all us, realtors, norm, title, escrow, insurance, inspections, repairs, goes on and on and on. Our job is to make sure that you are hyper focused when we ask you to be on whatever document we're presenting to you, because there's going to be a lot of things to sign and you're going to need to understand all of them. So it's not so much time that you have to take time off work. We're just saying we're there. Our job is to make everything clear to you and move you forward in the process so you're fully aware of what you're signing and what it means. Okay? All right, this is what my task list looks like every day. I pull it up and really it's just a little calendar. Starts at the very top with 0 days, meaning, oh, what's due today if I haven't done it already? Got to get that signed, got to get that reviewed, got to get that inspection, whatever it is. Then it goes to 1 days, 2 days, 3 days, 7 days out. And this is how we keep the process working. So we just have to check those little boxes off, get those things done, make sure you're aware and consent to everything we give to you. Okay? All righty. Well, we just shot Real Estate 101 through a fire hose at you. Hope you get a little idea of how the process works now. And we would be happy to take questions. And Norm, I think we have a question already.
Okay.
In terms of buying power from potential future rental income, would renting spare rooms be treated any different from buying a duplex and renting the other half? Seems like rooms would have higher tenant turnover than a duplex. Curious if lenders have a preference between types of rental income. Good question.
Yeah. Yes. And the answer is the duplex is a much better option. Room rent, quite honestly, is not included in income. Typically, if you want, we go to the tax returns to see if you've reported that room rental income, and most people don't do that. And we would need to have 2 years of showing that that rental income was coming in and was reported to the IRS. So anyway, the long and short of it is that it's better to buy a duplex, live in one side, and then rent out the other side. Hope
I
that helps.
I concur with you, Norm. And the only thing I would add on is you could do that same thing with an ADU.
Yep. Right. That's
Kind
right.
of kind of the same thing.
Yep. Exactly. Exactly.
And more people are doing it.
Yeah.
So one thing I want to point out that if anybody needs a real estate agent anywhere, I pay for a service where if you have a real estate license in any of the area of the United States, and you say, I want a realtor that specializes in such and such, I can look up who's available, I can interview them and give you a connection to that person. So I'm happy to do that. If anybody would like a purchase agreement, email me and I'll send one out to you. Otherwise, I know Norm and I both are always available if you have questions.
Right. Anybody else?
I only see the one so far. If you guys think of questions later, you can shoot them out to us, email,
Right.
text us, call us, whatever you want to do.
Right. Well, I want to thank everybody for joining us today and spending your lunchtime with us. And hopefully you receive some great information. I know you have. Mike is wonderful and knows his stuff and has been around for a long time. And that's why he does have that legacy, because he does know what he's doing. And also, please let us know if there's any other questions that you have. And thank you.
Thank you, everyone, and thank you, Amanda.
Yes, thank
Thank
you,
you,
Amanda.
everyone.
Thank
And
you.
also, just a
Oh,
reminder, everyone will get a slide copy of the slide deck in about a week, so you'll have Norm and Michael's contact information.
okay. And we just got a shout out. Thank you. So thank you for thanking us. We're
Yes,
happy
thank you.
happy
Thank
to
you.
do this.
All right.
All right, have a good day, everyone.